NMLS Exam Study Guide 800 Facts 2021. RESPA. The Real Estate Settlement Procedures Act, RESPA, provides consumer protection for loans on residential properties 1 to 4 units. Nothing of value can be given in exchange for the referral of business, with the exception of real estate brokerage firms that are allowed to exchange referrals between themselves. For test purposes, let's call it RESPA, if that helps you to remember that it is Reg X. RESPA Reg X is primarily involved with the disclosure of closing costs and prevention of kickbacks, which may raise the amount of closing costs to the borrower. The Consumer Financial Protection Act enforces RESPA regulations. HUD was the previous enforcer. RESPA does not apply to loans secured by commercial properties. RESPA does not apply to vacant land unless a dwelling is intended to be constructed on the land within 2 years. RESPA does not apply to properties containing 25 or more acres. That's agricultural property. RESPA does not apply to temporary finance, such as bridge loans and construction loans. RESPA Section 6. RESPA Section 6 deals with the mortgage servicer and mortgage servicing abuses. A mortgage servicer is a company that collects monthly mortgage payments, pays taxes, insurance, and other items as they come due, and notifies the borrower of late payments. Qualified Written Request, QWR. Homeowners who are having issues with their mortgage servicers may take advantage of a provision of RESPA, whereby a borrower may request information relating to the servicing of a loan. It's called a Qualified Written Request, or QWR, and imposes a duty to respond to borrower's inquiries. A Qualified Written Request, QWR, requires the lender acknowledge receipt of the request within 5 business days and seek to resolve the issue within 30 days, with the option to extend for 15 days if needed, in connection to notices or errors submitted by the borrower. RESPA Section 6 mandates a creditor to provide a monthly statement to a consumer. RESPA Section 6 states that creditors must promptly post a payment the day that it is received. RESPA Section 6 requires creditors to respond to a payoff request within 7 business days. RESPA Section 6 requires creditors to make disclosures to consumer 30 and 45 days prior to billing for forced place insurance. RESPA Section 6 states that creditors must resolve written consumer complaints within 30 to 45 days of the written receipt. RESPA Section 6 states that the lender must attempt to establish live contact within 36 days with the borrower who has missed a mortgage payment. RESPA Section 6 states that a creditor must provide a borrower with mortgage workout options, such as loan modifications, forbearance options, short sale options, etc., must be provided to the borrower within 45 days of a missed payment. RESPA Section 6 says a creditor must notify a borrower within 30 days after submission of a complete loan workout application if there is an option to save the home. According to RESPA Section 6, a creditor may not seek judicial foreclosure or a trustee sale action for at least 120 days for a borrower who is delinquent. RESPA Section 6 prohibits dual tracking, which is continuing to seek foreclosure actions while the borrower is being considered for other workout options. RESPA Section 8 now. Let's talk about Section 8. It prohibits kickbacks, fee splitting, and unearned fees. Unearned fees are also known as advance fees or upfront fees. Illegal referral fees are known as kickbacks. RESPA Section 8 prohibits giving or accepting anything of value in exchange for the referral of settlement services. Despite prohibiting kickbacks, RESPA does not prohibit payment of fair market value for goods and services that were actually received or performed. A thing of value may include gift cards, sports tickets, advertising space, marketing material, bearing a real estate agent's information to give to his or her client, etc. Promotional items with company logos are permitted. RESPA Section 9. RESPA Section 9 prohibits the seller from requiring the buyer to use a particular title company as a condition of the sale, unless the seller decides to pay for the title insurance and all other fees if they're pressed to use a particular title company. RESPA Section 9, if that is violated, then the seller could be sued for 3 times the amount of the title, which is called treble damages. That's the amount paid for service. RESPA Section 10 requires lenders to conduct an annual escrow analysis if the account has impounds, escrow accounts, and reserve accounts. The annual escrow analysis summarizes the activity in the impound account. RESPA Section 10 states that the lender can take no more than 1/12 of the annual amount of the property taxes and insurance premium for the purpose of the escrow account. That just means that they're paying it monthly. RESPA Section 10 states that in order to protect itself from escrow shortages, the lender may require a cushion that doesn't exceed an amount equal to like 1/6, which is 2 months of the total disbursements for the year. All lenders may not do this, but some lenders might. The word is they are providing a cushion. Overages of $50 or more discovered in the borrower's escrow account during the annual audit and analysis must be refunded to the borrower as though the borrower is not delinquent. The refund must be made within 30 days. RESPA disclosures include all of these following items: the Know Before You Owe booklet, also known as Home Loan Toolkit, a mortgage service and disclosure statement, list of HUD counselors, the AFBA disclosure form, the initial escrow statement, annual escrow statement, and the service and transfer statement. No, the GFE and the HUD, those are also RESPA disclosures. However, now they're only being used with mobile homes, reverse mortgage, and things like that. The lender must provide the borrower with a list of the 10 HUD-approved counselors. Remember that the mortgage service and disclosure statement is not the same document as the service and transfer statement. The mortgage service and disclosure is the standard form used to disclose to the borrower whether the lender intends to retain the mortgage in-house or handing the mortgage payments off to a third party. If they are going to have it in-house, they will be handling the monthly payments and paying the taxes and insurance obligation. This must be delivered to the borrower and within 3 business days of the loan application. The initial escrow statement itemizes the estimated taxes, insurance premiums, and escrow account charges anticipated to be paid from the escrow account during the loan's first 12 months. Usually it's given as settlement, but the lender has 45 days from settlement to deliver it. This is sometimes referred to as a hello letter, welcome to the new lender type situation. The service and transfer disclosures is often referred to as the goodbye letter in the industry. We're not servicing your loan anymore. Goodbye. You're going to have a new servicer. The new servicer is also required to send the borrower a notice, aka that hello letter. RESPA states that a service and transfer statement is required if the loan servicer sells or assigns the servicing rights to a borrower's loan to another loan servicer. NMLS Exam Study Guide 800 Facts 2021, this one starting at 44. The service and transfer disclosure is required to be provided to the borrower by the servicer no later than 15 days before the servicing rights are transferred to the new servicer. According to the service and transfer disclosure, there is a statutory 60-day grace period during which time any payment mistakenly made to the old servicer must be forwarded to the new servicer and no late fee can be assessed. Per RESPA, a complete application consists of the following 6 items: borrower name, social security number, subject property address, borrower's monthly income, estimated value amount, and the loan amount. Per RESPA, if a borrower has submitted a complete application, the initial disclosures are triggered and must be provided to the borrowers within 3 business days. If the application is withdrawn within the first 3 days, or the lender denied the application within the first 3 days, the initial disclosures are not required. Initial disclosures include the Home Loan Toolkit, Know Before You Owe booklet, on purchases only required by RESPA, HUD Special Information Booklet, non-purchase loans, affiliate business arrangement disclosure, the loan estimate, or the GFE if applicable, mortgage service and disclosure statement, and a list of HUD counselors. The Home Loan Toolkit, Know Before You Owe booklet, is intended to help persons borrowing money to finance residential real estate better understand the nature and cost of real estate settlement services. It must be delivered at or within 3 days of the application for consumers looking to purchase a property. This is for purchases only. If a referring party must give the affiliate business arrangement disclosure to the consumer, it must be immediately, at the time of referral or prior to loan consummation. If referring business where he or she has more than 1% interest in the referring business service for mortgage service transactions occurring after October 3rd, 2015. The GFE and the HUD have been replaced by two new forms called the Loan Estimate and the Closing Disclosure, the CD. However, the GFE and the HUD will continue to be provided for HELOCs, reverse mortgages, and loans securing mobile homes where the owner will not also own the land which the mobile home resides. The GFE and the HUD are RESPA disclosures. However, the loan estimate and closing disclosures are TILA disclosure. The closing disclosures must be delivered 3 business days before the loan consummation doc signing and a final closing disclosure at loan consummation or at doc signing. RESPA requires 2 disclosures that must be given as settlement: the closing disclosure CD and the initial escrow statement, which may be given 45 days of closing, within 45 days of closing, actually. Closing disclosures, they're not required when there is no federally related loan or no closing costs to the borrower or for most closed-end loans. Forced place insurance occurs if the lender chooses the hazard insurance company for the borrower who has allowed his policy to lapse. The TRID Loan Estimate LE combines the initial TILA disclosure and the GFE. The TRID Closing Disclosure, the CD, combines the final TILA disclosures and the HUD. The loan estimate must be delivered or mailed no later than 3 business days after a loan application is submitted. The terms of the loan estimate must be available for at least 10 days, must be available for at least 10 business days. This does not include the interest rate. When it is necessary to provide a revised loan estimate, it must be provided within 3 business days of receiving information sufficient to establish a valid change in circumstance. Documentation must be retained regarding the reason for the revision for 3 years. The creditor must make sure that the revised loan estimate is received at least 4 business days prior to consummation of the mortgage loan. Remember, the soonest that a loan can close is 7 business days. So 3 days plus 4 days equals 7 days. If the creditor places the revised loan estimate in the mail as a method of delivery, the creditor must mail the disclosure 7 business days prior to consummation of the loan to allow for the 3 business day receipt rule. Once the borrower receives the closing disclosure, a new loan estimate cannot be issued. If there is a valid change in circumstance that occurs after the closing disclosure is delivered, the borrower is to receive a new revised closing disclosure, not a revised loan estimate. A valid change in circumstance is defined under RESPA as an act of God, war, disaster, or other emergency, new information regarding the consumer, the loan, or the property, or information regarding the consumer's qualification for the loan on which the originator relied in providing the LE in the first place has changed or is later found to be inaccurate. The following are not considered valid change in circumstances, as defined under RESPA: errors in disclosing an initial or subsequent LE, or delays in underwriting, checking in conditions leading to the lock extension fees. Examples of change circumstance could include any of the following: interest rate lock, appraisal value comes in lower than expected, creating a pricing adjustment for the higher LTV. Loan program is flipped from conditional to FHA, adding UFMIP. The consumer's credit score drops, resulting in a pricing increase. Consumer requests a change in the loan amount, interest rate, loan program, or terms, leading to an increase in settlement costs. The seller delays because they're waiting on a short sale approval. Changes in the APR loan product or the addition of a prepayment penalty triggers a revised closing disclosure. And an additional 3 business day waiting period. That's called redisclosure. When a consumer requests the cancellation of their escrow account, the lender must deliver an escrow closing notice no later than 3 business days before closure. If the escrow account is closed for some other reason, except for default or termination caused by refinance, repayment, or rescission, the notice must be sent 30 business days prior to closure. Lenders must retain a closing disclosure and related documents for 5 years after closing. Lender must retain a loan estimate for 3 years after closing. The escrow closing notice must be provided by the creditor prior to canceling an escrow account for any consumer who had one already established by the creditor. Regarding the escrow closing notice, if the consumer requests to close, this notice must be received at least 3 business days before the consumer's escrow account is closed. If the escrow is closed for any other reason, the creditor is required to provide the notice within 30 business days. The lender must retain the escrow cancellation notice for 2 years after loan consummation. A partial payment policy disclosure is found on the closing disclosure regarding the acceptance of partial mortgage payments by the loan servicers. The disclosure informs the consumer about the policy and the acceptance of payments less than the full amount due under the note. The lender must retain the partial payment policy for 2 years after loan consummation. NMLS Exam Study Guide 800 Facts Part 3. A tolerance is how much of a change a particular item can tolerate between the loan estimate and the closing disclosure CD before it's in violation of the law. Some items have zero tolerance, others may have a 10% tolerance level, and some items have no limit on how much they can vary. The following items have zero tolerance: real estate transfer taxes, loan origination fees, and interest rate. Other zero tolerance items include the appraisal and the credit report. The following items have 10% tolerance: fees that the lender chooses or identifies, such as government recording fees, title insurance. These fees cannot vary by more than 10% between the loan estimate and the closing disclosure. The following items have a no tolerance limit: fees for services that the owners choose for themselves, such as hazard insurance, title insurance, if the homeowner doesn't choose one of the lender-identified selections, and fees that are paid per diem, prepaid mortgage interest. The lender has 60 business days after the closing to refund to the borrower any portion of the charges that exceeded the acceptable amount of a stated tolerance level. Non-numeric clerical errors and tolerance violations trigger a new closing disclosure that must be delivered within 60 calendar days following the loan consummation. Likewise, closing disclosure tolerance refunds must also be sent within 60 days. The closing costs greater than the loan estimate are said not to be made in good faith. Closing costs that are less than the loan estimate are said to have been acted in good faith by the MLO. TRID rules do not apply to HELOCs, reverse mortgages, mortgages for mobile homes not secured by real estate. The rate lock information is only found on the loan estimate form. Although mortgage brokers may provide the loan estimate to the borrower, the creditor is the ultimately responsible party for the delivery. As it relates to the loan estimate, a business day is any day in which the creditor is open to the public for the purpose of conducting regular business activities. Note the difference from the definition of a business day for the closing disclosure. No fee, with the exception of a bona fide and reasonable credit report fee, may be received by the MLO or the creditor until the borrower has received the loan estimate. Penalty for violating RESPA is $10,000 and or up to 1 year in jail. The main purpose of RESPA is to help consumers become better shoppers for settlement services. RESPA considers the following as settlement service: title searches, title examinations, title insurance, attorney services, preparation of documents, surveys, credit reports, appraisal, pest inspections, real estate services, loan origination, and processing mortgages, and closing or settling mortgages. And we're going to talk about TILA, the Godzilla. TILA, the Truth in Lending Act, was passed by Congress in 1968 as part of the Consumer Credit Protection Act. TILA is now administered by the Consumer Financial Protection Bureau, CFPB. TILA was implemented by the Federal Reserve Board as Regulation Z, Reg Z. TILA promotes the informed use of credit by disclosing finance charges in a uniform manner using the annual percentage rate, APR. TILA was enacted to protect consumers during credit transactions. TILA deals with credit APR and advertising of consumer loans. Regulation Z applies to residential mortgages, 1 to 4 units, owner-occupied, and does not include commercial or non-residential loans. TILA applies to credit transactions that are payable in more than 4 installments. TILA disclosures include the loan estimate, the closing disclosure, Consumer Handbook on Adjustable Rate Mortgages, which is the CHARM booklet, the When Your Home is on the Line booklet, ARM disclosures, Notice of the Right to Rescind disclosures, and balloon payment disclosures. Reg Z covers 3 general areas: disclosure of financing charges, distribution of the Consumer Handbook on Adjustable Rate Mortgages, the CHARM booklet, and the right of rescission. The CHARM booklet is required to be provided to the borrower when he or she receives an adjustable rate mortgage. The When Your Home is on the Line disclosure is required to be provided to the borrower if he or she receives a home equity line of credit, a HELOC, or home equity line of credit loan. There's a difference between just the line of credit and the equity line of credit. One is considered closed in, the home equity line of credit, and one is considered to be open in, the HELOC. It might sound a little confusing, but if you borrow $20,000, you pay it all back. That's the home equity line. If you borrow $50,000 and you only use 10, and you only pay back 10, you still have more there. That's the one. That's the line of credit. Just so maybe clean that up a little bit. The transfer of ownership disclosure requires that the entities that purchase or acquire a mortgage loan notify the borrower and provide the name, address, and telephone number of the new owner of the mortgage within 30 days of the application. The transfer of ownership disclosure only applies to primary mortgage. Do not confuse the transfer of ownership disclosure with the transfer of servicing disclosure. The owner of the loan and the servicer of the loans are frequently separate entities. The ARM disclosure. Some disclosures under TILA are specific to adjustable rate mortgages, loans, which are considered ARMs. Loan servicers must provide a borrower with an ARM at least 60 days notice before an interest rate change occurs if that change will result in a new payment. The loan estimate is a TILA disclosure and is required to be provided to the borrower at within 3 business days of the initial loan application. It provided the borrower the potential estimate it provides the borrower the potential estimate of what the closing costs are going to be. According to TILA, a completed application requires use of the 3-page loan estimate, which discloses settlement service provider costs, the initial annual percentage rate of the loan, estimated cash to close the transaction, and other features. The annual percentage rate of the loan, estimated cash to close. Yeah, I said that one. Okay, the closing disclosure is a TILA disclosure which is required to be provided to the borrower 3 days prior to loan settlement doc signing, with the final copy of the CD being provided at the actual settlement, which is doc signing as well. It provided the borrower with the actual closing costs. TILA requires the delivery of the 5-page closing disclosure, which contains the final terms of the mortgage loan costs, and various loan disclosures 3 days prior to the loan consummation. The closing disclosures combines the HUD-1 settlement statement and the final truth in lending disclosures. The APR is not simply the interest rate that appears in the promissory note, known as the note rate. Rather, it reflects certain finance charges associated with the loan that is spread out over the life of the loan. Therefore, the APR is generally higher than the note rate. The APR is the total cost of all items plus finance charges expressed as a percentage in the loan. The APR disclosure must occur within 3 business days after receiving a signed loan application. Another word for the APR is the effective rate. Another word that is used for the interest rate, actually 2 words here, the note rate and the nominal rate. The total interest percentage tip is similar to the APR, but this the total interest being charged over the life of the loan, expressed as a percentage. This is different from the APR because the fees are not included. The APR is the total interest being charged over the life of the loan, plus all finance charges expressed as a percentage. NMLS Exam Study Guide 800 Facts 2021. This is batch 4. A qualified mortgage is one that follows stated guidelines intended to reduce a lender's potential liability A qualified mortgage is a home loan that meets certain standards set forth by the federal government, one in which creditors are presumed to meet the ability to repay, ATR, requirements if they make a qualified mortgage. A qualified mortgage has no excess fees and points. Points and fees paid by the borrower must not exceed 3% of the total amount borrowed in order to be considered a qualified mortgage. A qualified mortgage has no toxic features, no interest-only loans, no negative amortization laws, no balloon payments. A qualified mortgage has no terms beyond 30 years. A qualified mortgage must have terms that are 30 years or less. A qualified mortgage limits the debt-to-income ratio. The qualified mortgage granted to borrowers must not have back-end debt-to-income ratios higher than 43%. Qualified mortgage creates safe loans by prohibiting certain high-risk products and features. The 8 items that a lender must consider to determine if a borrower meets the ability to repay requirements include an evaluation of the following criteria: current income or assets, current employment status, borrower's credit history, monthly payment for the mortgage, borrower's monthly payments on simultaneous mortgage loans, monthly payments on other mortgage-related expenses, for example, property taxes and insurance, etc., other debts of the borrower, and his or her debt-to-income ratios. Penalties for violation of TILA: $5,000 per day for a single violation, $25,000 per day for reckless violation, and $1 million per day if knowingly violated TRID rules. So, none of these lenders are going to be doing anything like that. They're going to stick to the rules and make sure that they are in compliance. Business days, all calendar days except Sunday and legal public holidays according to TILA, with the exception of the loan estimate, the initial loan estimate actually, which defines a business day as any day that the creditor's office is open for business. For example, if a creditor's offices are only open to the public on Sundays and every Veterans Day, these days are considered their business days. Prepaid finance charges are used to calculate the APR. The following prepaid finance charges are included in the calculation: the origination fees, discount points, tax service fees, underwriting fees, processing fees, prepaid per diem interest, mortgage insurance premium, mortgage insurance impounds on reserves, warehouse fees, VA funding fees, FHA, UFMIP, buy down, flood certification fees, closing costs, and courier fees. Some calculation fees are not included in the prepaid finance charge using the APR. The title insurance, escrow for taxes and insurance, notary fees, appraisal fees, termite inspection fees, and credit report charges. Those are not included. TILA, RESPA integrated disclosures. According to TRED, the definition of an application is described as submission of the following 6 items: the borrower's name, monthly income, borrower's social security number, for credit report, property address, estimated property value, loan amount, and once an application has been defined, it is considered to be submitted and it triggers the results for needing the first set of disclosures that's going to come out. Once the application again that's received, the borrowers are obligated to go ahead and issue them a loan estimate. The creditors may not require any additional information or verification before they actually issue the loan estimate. The creditor may either hand deliver the disclosures on or before the 3rd business day, or they can put them in the mail on the 3rd business day in order to comply with the requirements of the rule that they get them 3 business days after they've been submitted to the lender. If the disclosures are mailed, the consumer is deemed to have received them 3 days after they were mailed. When counting mailing time, include Monday through Saturday, do not include public holidays. The 7-day closing rule says that the loan may not close for 7 days after the disclosures are mailed. For this rule, we do not need to wait the 3-day mailing period. In other words, you may start counting the 7 days at the earlier or actually delivering the disclosures to the consumer or mailing them. Collection fees: according to TRED, a lender or broker may not charge the borrower anything but a reasonable credit report fee until the borrower has received the loan estimate and expressed the intent to proceed. The borrower may communicate intent to proceed orally, in person, upon receiving the disclosure. If communication comes after the borrower received the disclosure, it may come verbally over the phone. in writing, via email, or through signing a form. However, silence on behalf of the borrower may not be used as consent. There's got to be some type of communication to let us know that they are deciding to move forward. Let's talk about ECOA, Equal Credit Opportunity Act. The creditors have to be equal. ECOA stands for the Equal Credit Opportunity Act. The Consumer Financial Protection Bureau enforces ECOA. ECOA is Regulation B and requires that creditors do not discriminate when granting credit. They must be equal. ECOA primarily deals with the credit application. ECOA Regulation B also specifies that the borrower is entitled to a copy of the residential property appraisal report at least 3 business days before closing the loan or at loan consummation. The Equal Credit Opportunity Act, ECOA, prohibits discrimination by lenders in any part of a credit transaction on the basis of race, color, religion, national origin, sex, marital status, age, provided the applicant has attained the minimum legal age in the state where the application is being done, and also for a reverse mortgage, there must be at least 62 or older. The receipt of income from public assistance program or having exercised any rights under the Consumer Credit Protection Act. Copies of appraisals upon receipt of an application. The lender has 3 days to notify a borrower of the right to receive a copy of any appraisal or valuation. Required credit bureaus to maintain separate credit files. ECOA does that. For married spouses, they can request that if they want it that way. ECOA allows the credit applicant to file discrimination complaints or bring civil lawsuits for alleged discrimination. Remember, Reg B said they must be equal. ECOA prohibits a creditor from inquiring about a consumer's marital status or intentions related to having or raising children. ECOA also provides creditors from making any oral or written statement in advertising or otherwise to applicants or prospective applicants that would discourage them from making or pursuing an application on a prohibited basis, such as membership in a protected class. ECOA has 8 protected classes: sex, race, religion, color, national origin, age, marital status, and public assistance. The first 5 are also protected by the Fair Housing Act. The last 3, age, marital status, and public assistance, are only protected by ECOA. ECOA prohibits creditors from refusing to consider or discounting income from alimony, child support, maintenance, that means separate maintenance, if the borrower chooses to disclose it. They don't have to use it, but if they want to qualify for the loan they're applying for, and this money may actually help them qualify. It is because of ECOA that lenders cannot ask if a borrower is single, widowed, or divorced. They can only ask if the person is married, unmarried, or separated. And these are the only choices that are on the loan application. It is permissible to ask a client about marital status, since the likely impact the loan and our documents needed at closing. However, if the applicant is not legally married, it's not permissible if he and she is divorced, widowed, etc., for us to ask them if they are divorced, widowed, etc. A loan originator should not ask an applicant how many children do they have or plan to have. The proper way to obtain this information is, how many dependents do you have? According to ECOA, a creditor also may not ask an applicant if any income stated on the application is derived from alimony, child support, unless the applicant wishes that that income be considered and determine their eligibility for the loan. ECOA. We're going to start NMLS Exam Study Guide 800 Facts 2021, talking about ECOA a little bit more. ECOA dictates the collection of demographic information in order to monitor the lender's compliance with the law. Specifically, on the bottom of the 3rd page of the 1003 loan application, the interviewer must specifically ask the applicant's race, ethnicity, and sex when the loan application is being taken face-to-face. ECOA requires credit bureaus to keep separate files on married spouses if requested. ECOA notification of adverse action, a denial letter, must be in writing. A telephone call is not sufficient. ECOA states that a creditor must provide an answer on a credit application 30 days after the receipt of an application. The answer could result in an approval, an adverse action, which is a denial or request for additional information. ECOA states that a creditor must notify the applicant of action taken on an application within 90 days after notifying the applicant of a counteroffer if the applicant does not expressly accept the offer. The notice of adverse action must contain a statement of the action taken, contact information for the lender, the name and address of the federal agency with the jurisdiction, and the reason for the decision, or a statement advising the borrower of their right to receive the reasons they were actually denied. An applicant can request a statement of reasons within 60 days of receiving the original adverse action notice. When adverse action is taken, an application has been denied, the applicant was offered less favorable terms than those they applied for, or there was a change in terms of an existing credit agreement, the creditor must either provide notice of the specific reasons for the decision or inform the applicant of his right to request specific reasons for the decision within 60 days. ECOA prevents creditors from discriminating against a borrower's source of income. However, the creditor can discriminate against their amount of income, meaning that it doesn't matter where the income is coming from. It could be Social Security, disability, or whatever. It has to be enough to satisfy the loan, the payment for the mortgage that they are actually applying for at the time. So they can't discriminate against the source, but they can discriminate if the amount coming in is not sufficient to pay the mortgage on the loan that they are actually applying for. In order to make sure that the loan originator is not violating ECOA, he or she must refrain from asking questions that may be construed as discriminatory. For example, a loan originator should never ask a borrower whether any portion of his income is derived from alimony, child support, or public assistance. If an application for credit is denied based on the appraisal under ECOA Regulation B, says the borrower has 90 days to request a copy and the lender has 30 days to deliver it. ECOA prohibits the lender from discouraging individuals from applying for a mortgage or reject their application because of their race, color, sex, religion, national origin, marital status, or age, or because they receive public assistance. Child rearing. About plans for having children, childbearing, and capabilities of birth control practices, ECOA states that the lender and the MLOs are not allowed to ask the borrowers these questions related to how many children they're planning on having in their family. Accreditors shall not inquire about birth control practices, intentions concerning the bearing or rearing of children, or the capability to bear children. A creditor may inquire about the number and ages of an applicant's dependents or about dependent-related financial obligations or expenditures, provided such information is requested without regard to sex, marital status, or any other prohibited class. Overt discrimination is discrimination that is explicit or obvious. An example would be advertising that indicates members of a protected class are not welcome at the institution. Alternatively, overt discrimination might exist if there is a widespread understanding in the community that members of a protected class will not be served by an institution. Disparate treatment is a discrimination that is defined by differences in the way a member of a protected class, race, religion, or sex, etc., are served by an institution. Disparate treatment is discrimination that is defined by differences in the way members of a protected class are actually served by the institution. For example, an individual may be engaging in disparate treatment by shaking the hand of members of one race or gender and not following the same procedure with members of another race or gender. Disparate treatment can also occur if members of a protected class are charged higher fees and are fees that similarly situated members than a non-protected class, higher fees than the other one. Disparate impact, that's a method of identifying discrimination through statistical analysis. It occurs when a practice or policy that appears to be non-discriminatory on the face has a disproportionate negative effect on members of a particular race, gender, or other protected class. Unlike other forms of discrimination identified via disparate impact is often illegal, even if the discrimination is unintentional. For example, one of the largest fair lending settlements based on disparate impact theory alleged that a creditor's minimum credit score policies resulted in a disproportionate number of minority applicants receiving FHA loans instead of less expensive conventional loans. HMDA v. COA. Government monitoring information is Section 10 of the 1003 at the moment. HMDA requires that this section be completed in order to comply with the government monitoring requirements. The applicant must be informed that this information is only used to assure that the lender is not discriminating against applicants and is not considered when determining whether to grant the loan or not. Under ECOA, if the application is taken face to face, this section will be completed based on visual observation. That section is actually going to be moving in the coming year. It's going to be considered as Section 8 of the 1003, and it's going to be called demographic information, but everything else about it will actually remain the same. Creditors may not issue revisions to a loan estimate due to technical errors, miscalculations, or underestimations of charges. Whether the creditor is making this disclosure or mortgage broker is making the disclosure on the creditor's behalf. The loan estimate must be given to the borrower no later than 4 business days before consummation or placed in the mail no later than 3 business days after the creditor receives information sufficient to justify a revision. This is to ensure that the 7 business days must pass between delivering or mailing the loan estimate or revised loan estimate before the loan may close. 3 days plus 4 days equals 7. ECOA records must be kept for 25 months. A consumer can sue for a violation of ECOA for up to 24 months, so therefore that's why the records must still be available. The penalty for violating ECOA is $10,000. I want to talk about the Fair Housing Act. The Civil Rights Act of 1866 prohibits public and private racial discrimination in any property transaction in the United States. That was the beginning. The Civil Rights Act was later amended to Title 8 of the Civil Rights Act of 1968, and it has morphed again and is now commonly just called Fair Housing Act. The Fair Housing Act prohibits discrimination in the sale and lease of residential property. ECOA prohibits discrimination in credit transactions. Fair housing prohibits discrimination in lease or rental of residential property. They both deal with discrimination, so don't get them confused on the test. They have 2 specific reasons and 2 specific types of discrimination that they deal with. Under fair housing, there are 7 protected classes: sex, race, religion, color, national origin, disability, and familial status. The first 5 are also protected by ECOA. The last 2, disability and familial status, are only protected by fair housing. Familial status, the fact that there's an adult has a child in the house that's 18 years or older. Redlining is the illegal practice of lenders arbitrarily denying or limiting financial services to specific neighborhoods. To combat redlining, the Community Reinvestment Act, CRA, was enacted to reduce discriminatory credit practices against low-income neighborhoods. It was designed to meet the credit needs of the community. And then there was HMDA. To further reduce redlining, the Home Mortgage Disclosure Act, HMDA, requires lenders to file reports regarding all loans made during the year. It is designed to meet the housing needs of the community. NMLS Exam Study Guide 800 Facts 2021. This one starts at 318. Under the HIPAA, borrowers can request a cancellation when it reaches 80%, which will usually be granted if they have a good payment history. HIPAA allows borrowers to accelerate the cancellation date by making additional payments that bring the LTV to 80%. Lenders may require evidence that the value of the property has not declined below its original value and that the property does not have a second mortgage, such as a home equity loan. The e-Sign Act allows electronic records and electronic signatures to be valid whenever a regulation requires a document to be in writing, as long as the consumer has consented to use it. The e-Sign Act ensures the validity and legality of contracts and documents that are entered into by electronic methods. The e-Sign Act, a party to a contract, cannot be forced to use electronic signatures methods and may sign in ink, also called wet signatures. One party can use electronic signature method, while the other party to the contract can retain the rights to sign the documents personally, which would be considered a wet signature. The USA Patriot Act requires mortgage applicants to provide their name address, social security number of employee identification number, and a government-issued photo ID. The USA Patriot Act increases the ability of law enforcement agencies to search telephones, email, medical, and financial records. The USA Patriot Act was created to prohibit money laundering and the financing of terrorist activities. The USA Patriot Act requires financial institutions to verify the identity of account holders, compare the account names to names in the federal database of fugitives and suspected terrorists, establish an anti-money laundering policy, and train employees on the policy. Mortgage acts and practices, advertising, that comes under Regulation N. Regulation N was issued by the Consumer Financial Protection Bureau in order to prohibit false or misleading advertising of mortgage products. MAP applies to any commercial communication designed to produce a sale or to create interest in mortgage products or services. It is illegal to misrepresent any loan terms or conditions in an advertisement. In general, Regulation N prohibits misleading claims by mortgage lenders concerning government affiliation, interest rates, fees, costs, payments associated with the loan, and the amount of cash or credit available to the consumer in any commercial communication. Copies of the commercial communication and supporting documents must be kept for 2 years. The HUD Equal Access Rule states that a lender cannot inquire about an applicant's sexual orientation or gender identity. Let's talk a little bit here about just general mortgage knowledge. General mortgage knowledge. The Federal National Mortgage Association, Fannie Mae, is known as Fannie Mae. Fannie Mae is the largest institution of buyer of conventional mortgages in the secondary mortgage market. The secondary market includes private investors or government agencies that buy or sell real estate mortgages. The Federal Home Loan Mortgage Corporation, Freddie Mac, was chartered by the federal government to buy mortgages that originate in savings and loans associations. The Government National Mortgage Association, or Ginnie Mae, is a wholly owned government corporation within the United States Department of Housing and Urban Development, HUD. Ginnie Mae does not buy or sell loans or issue mortgage-backed securities, MBSs. Ginnie Mae guarantees investors the timely payment of principal and interest on mortgage-backed securities that are backed by federally insured or guaranteed loans, mainly loans insured by the Federal Housing Administration, FHA, or guaranteed by the Department of Veterans Affairs, VA. Fannie Mae's automatic underwriting system is known as Desktop Underwriter, or DU. Freddie Mac's automated underwriting system is known as Freddie Mac's Loan Product Advisory. It was formerly just called Loan Prospector, or LP. The 2020 maximum conforming loan limit was raised to $510,400, up from 2019's level of $484,350. Fannie Mae requires only a 7-year history to be reviewed for all credit and public record information. A conventional mortgage requires a minimum 3% down payment for first-time home buyers. Generally, the minimum is 5% down payment. A conventional mortgage is not insured or guaranteed by the government. A conventional mortgage requires private mortgage insurance on loans with less than a 20% down payment. Private mortgage insurance, a policy that allows lenders to recover part of loss in the event of a borrower's default or loss in collateral value. Most conventional mortgages are not assumable. They do have a due on sale clause. A conventional mortgage that has a 5% late fee of the P&I amount only. Government loans, FHA, VA, USDA, they have a 4% late fee of the P&I amount only. The down payment amount on a conventional conforming loan, it could vary. However, on a conventional loan, 5% of the down payment must come from the borrower's own funds. FHA insured loans require 3.5% down payment, and it can be a gift. VA and USDA guaranteed loans do not require a payment. A jumbo loan exceeds Fannie/Freddie maximum loan amount. They're also called non-conforming loans, P&I debt service is the monthly principal and interest payment. Late fees are either 4% or 5% of the debt service, not the PITI. Escrow and pounds are usually collected by the lender as part of the monthly mortgage payment. They include the monthly amount for property taxes, hazard insurance, and flood insurance if required. PITI is principal, interest, taxes, and insurance. Hazard, flood, and mortgage insurance is included in that. It is also called the monthly housing expense. Fannie Mae requires the non-qualifying spouse to sign the mortgage or any other documentation required to evidence that the spouse is relinquishing all rights to the property. The maximum term for a Fannie Mae loan is 30 years. Fannie Mae is the largest institutional investor in the secondary mortgage market. It purchases FHA, VA, conventional loans from commercial banks. Fannie Mae requires guaranteed funds such as a cashier's check from a bank or reputable financial institution to pay for the closing costs. Personal checks are not acceptable. Fannie Mae emphasizes the borrower's continuity of stable income versus stable employment. NMLS Exam Study Guide 800 Facts 2021, 361. Fannie Mae requires a borrower to have a Social Security number or individual taxpayer identification number. Fannie Mae holds the lender responsible for the quality of the appraisal. Fannie Mae requires the lender to obtain a written credit report for each borrower on the loan application who has an individual credit record. Fannie Mae will not accept a co-borrower's income for qualifying purposes unless the co-borrower also signs the mortgage note. Fannie Mae does not purchase most balloon mortgages. At the time of the loan application, the lender normally requires the applicant to sign a form authorizing the lender to obtain verifications of bank balances, Fannie Mae 1006, and payroll information, Fannie Mae 1005. The Fannie Mae 1008 transmittal summary is a form that summarizes the applicant's data and will usually be the top sheet in the loan package when it is sent to the underwriter. Fannie Mae will purchase mortgages secured by residential properties in urban, suburban, and/or rural areas. Fannie Mae was created as a government agency in 1938 and later became a public company listed on the New York Stock Exchange. The purpose of Fannie Mae is to buy mortgages and the notes from the primary lender so that the money remains in circulation. Fannie Mae does not purchase mortgages on agricultural type properties such as farms, orchards, ranches, or on undeveloped land or land developed type properties. Fannie Mae will not purchase a mortgage that has an unacceptable title impediment. Fannie Mae will purchase first mortgages that are secured by residential properties for use by 1 to 4 families. The occupancy may be that of a principal residence, a second home, or investment property. Fannie Mae will purchase a conventional mortgage on a manufactured home. The manufactured home must be a one-family dwelling that is legally classified as real property. When the mortgage that is being delivered to Fannie Mae is secured by the borrower's principal residence, Fannie Mae has no limitation on the number of mortgages that the borrower can currently be financing. But if the mortgage is secured by a second home or an investment property, the borrower may not be financing more than 10 properties. Fannie Mae recommends that a lender obtain a minimum of 2 credit scores for every borrower. If there are 2 credit scores, use a lower one. If there are 3 credit scores, use a middle. This is the representative score for a single borrower. If more than one individual is applying for the same mortgage, the lender should determine the single applicable credit score of each individual borrower and then select the lowest applicable score from the group as the representative credit score for the mortgage. Alt-A loans are characterized by reduced documentation, high ratios, or limited assets. Subprime loans are the riskiest and are associated with poor credit scores. Amortization is a process of fully paying off a loan in regular payments over a specified period of time. The portion of each monthly payment that goes to reduce the outstanding principal balance gradually increases with each payment throughout the life of the loan, and the portion used to pay interest gradually decreases each month. Payments applied to principal and interest of the loan, and the portion used to pay interest gradually decreases each month. Payments applied to the principal and interest, I think I said that. Anyway, positive amortization occurs when the monthly mortgage payment decreases the loan balance by applying a portion of each payment to the principal. Negative amortization occurs in a mortgage repayment plan in which the borrower makes payments that amount to less than the interest due. Unpaid interest is added to the outstanding loan balance, causing the outstanding loan balance to increase instead of decrease. Monthly payment is not sufficient to cover the accrued interest from the previous month. A senior mortgage or first mortgage has a superior lien position. A junior mortgage, subsequent mortgages, has a lower or more subordinate lien position than the senior mortgage. There is an unlimited possible number of junior mortgages and no restrictions on terms. A fixed rate mortgage is one example of a fully amortized loan. During the first few years of the loan, most of the monthly P&I, principal and interest, is going toward paying the interest. Payments during the last few years are almost entirely principal repayment. A balloon mortgage is partially amortized. Monthly payments are usually calculated as if it was a 30-year term, but the balance of the loan will come due before that time and has to be paid in one lump sum. 5, 7, and 10-year terms are popular. A 360/180 loan is a balloon payment amortized over 30 years with a lump sum payment due after 15 years. An adjustable rate mortgage, an ARM, consists of two parts, an index, which fluctuates, and a margin, which is fixed. Index plus margin equals the fully indexed rate. The index is known fluctuating published economic indicator outside of the control of the lender. U.S. Treasury securities rate and the London Interbank Offered Rate, LIBOR, are two common indices. The margin is a fixed percentage rate, is typically 2% to 3% that is added to the specific index at each adjustment period to determine the fully indexed rate. It reflects the lender's profit and overhead, added to the index to find the current interest rate charged, but sometimes it's actually called the spread. The margin is expressed in basis points where 100 points is equal to 1%. The adjustment period specifies the initial term before the first interest rate adjustment. After this first period, the loan typically adjusts every year. Rate caps limit how much the interest rate can change at each adjustment period and over the life of the loan. A 2/3/6 has a max first adjustment of 2%, subsequent max adjustments of 3%, and a lifetime max adjustment of 6%. A biweekly mortgage is one in which the borrower must make a mortgage payment every 2 weeks. This allows the borrower to build up equity faster and pay less interest over the life of the loan. A term mortgage is a non-amortizing interest-only loan. The balance is due at the end of the term in a balloon payment. Net tangible benefit. Refinance loans must make sense for the consumer. They must provide some benefit. The cost or commission earned for the loan cannot outweigh the benefit that the borrower will receive. Who are 62 years or older and have a large percentage of their current mortgage paid off. They are non-recourse loans, and the lenders cannot file a deficiency judgment against the heirs. The heirs are not personally liable for the note. On reverse mortgage, there are no payments due from the borrower. The nationwide maximum loan amount for a reverse mortgage is $726,525. A growing equity mortgage, a GEM. This is a fixed rate mortgage to set up like a 30-year conventional mortgage loan with payments that increase regularly. It has a fixed interest rate and increase in payments so that the loan balance is paid off more quickly. A reverse mortgage allows a qualified borrower 62 and older to convert equity in home without selling or making payments. FHA's reverse mortgage is called a home equity conversion mortgage or a HECM. A reverse mortgage still requires DFE and TIL, not the loan estimate and closing disclosure. On a reverse mortgage, the balance of the loan rises as equity shrinks. Rising debt, falling equity. Most borrowers in a reverse mortgage receive their funds via the tenure method, getting a monthly check instead of paying a monthly check. No income requirement in a reverse mortgage, however, the borrower must be able to pay continuing obligations related to the property, such as property taxes, insurance, and upkeep of the property. The amount the applicant may borrow is based on the age of the youngest borrower, the value of the property, and the expected interest on the loan. Reverse mortgages require that the homeowner meet with a counselor to ensure that he or she understands how the program works. If not in breach, a reverse mortgage becomes due when the last surviving borrower dies, sells the home, or ceases to live in the home for 12 consecutive months. A traditional mortgage is defined as a 30-year fixed mortgage. A non-conforming loan does not meet Fannie or Freddie Mac standards and cannot be sold to the secondary market. Fannie Freddie non-conforming loans include, among other things, jumbo loans, Alt-A loans, subprime mortgages. A package mortgage can be either amortizing or non-amortizing, and the lien includes personal property as well as real property. Graduated payment mortgage, or GPM, is a mortgage in which the payment starts low and increases over time. This is a specialized payment structure that allows the borrower to make a smaller payment in the early years of the mortgage, with payments increasing yearly until they are sufficient to fully amortize the loan. The lower payments in the beginning usually cause negative amortization. Variable balance mortgage, or VBM, is a loan with an adjustable interest rate, but with payments that never change. Instead, as the rate increases or decreases, the balance decreases slower or faster as payments are made. A wraparound mortgage is usually a type of seller financing in which the seller finances enough money to cover the existing loan balance as well as in additional funds needed by the borrower. A seller wraparound mortgage has the seller retain the existing mortgage. The buyer makes one large payment, the seller pays the lender and keeps the difference. Seller financing is when the seller extends credit to the buyer to finance the purchase of the property. A purchase money mortgage or seller held mortgage is given by the buyer to a seller to secure part or all of the money the borrower needs to purchase the property. A seller may take part of the purchase price as a mortgage to help the sale, sometimes referred to as a seller carryback loan. Home equity line of credit is a form of revolving credit in which the home serves as the collateral. The amount of the available credit line usually depends on the borrower's equity in the home, appraised value, and the loan balance, which equals the borrower's equity. The index is a statistical report used as a reliable indicator of cost of money, such as coffee, cozy, LIBOR, prime interest rate. The rate adjustment period, that's the interval at which the interest rate changes. Interest rate caps. Caps limits the number of percent points the interest rate can rise or fall. A rate cap is a limitation on the amount that an interest rate may increase or decrease at the adjustment date or over the life of the loan. These are referred to as adjustment caps. There are three types of rate caps on most ARM loans. The initial cap applies to only the first rate adjustment. The periodic cap applies to all subsequent adjustment periods, and the life cap sets the maximum number of percentage points that the rate can increase for the life of the loan. An ARM, an introductory rate that is lower than the fully indexed rate at the time of closing, is called a teaser rate. For example, caps equals 5/2/6. In this scenario, the loan could adjust 5% at the first adjustment period and indicates the percentage that the rate increases from the start rate or initial rate. 2% at every adjustment period thereafter indicates the percentage that the rate increases or decreases from the current rate. But it could only adjust 6%. The cap indicates the maximum rate and increase over the life of the loan. The floor is the lowest ARM rate to which the ARM may adjust. Payment shock. Most ARM use caps to prevent payment shock. Payment shock is when the borrower's rate payment increases in a large amount all at once. Convertible arms is given borrowers the right to convert from an ARM to a fixed rate loan. Purchase money mortgage occurs when a borrower obtains a mortgage from the seller to purchase a home. Hybrid mortgage combination of a fixed and adjustable rate and are interest rates only. There's an example of a 5-year fixed that stays fixed for 5 years and then adjusts 25 years after. A balloon is also known as a partially amortized loan. It has periodic payments that do not fully amortize the loan by the end of the loan term. The final payment is larger than the others and is known as a balloon payment. Credit documents must be no more than 120 days old on the date the note is signed. This includes the new construction as well. FICO scores were developed by the Fair Isaac Corporation. A first-time home buyer is a buyer that is someone who is purchasing an owner-occupied primary residence and who has not had an ownership interest in an owner-occupied property for the past 3 years. The borrower should be a natural person and not a corporation. There is no maximum age limit for a borrower. NML Exam Study Guide 800 Facts 2021. A guarantor or cosigner is a credit applicant who does not have ownership interest in the security property, but who signs the mortgage note and thus has joint liability for the note with the borrower who is the owner of the note. A 5/1 ARM has a fixed interest rate of 5 years and adjusts annually after that. Construction mortgage, a temporary loan used to finance the construction of improvements and buildings on land. The 3 common disbursement plans in a construction mortgage are the fixed disbursement plan, the voucher system, and warrant system. After the loan is approved and funded, construction funds are placed in an account and released to the borrower and the builder as draws or obligatory advances. Permanent financing takeout loan. The construction is complete. The loan is replaced by a permanent amortizing loan. A foreclosure is the enforcement of a lien, a proceeding to extinguish all rights, title, and interest of the owner of a property in order to sell the property and satisfy any liens against it. Forbearance is the choice by the lender not to take action even though the borrower is in default of the loan. A lis pendens is a notice filed by the lender when it initiates a foreclosure lawsuit. It's lis pendens, L-I-S space P-E-N-D-E-N-S. The equitable right of redemption allows the mortgagor in default to pay the entire balance due and keep the property from being foreclosed. A deficiency judgment allows the lender to claim other assets from the borrower when the proceeds of the foreclosure sale are insufficient to satisfy the mortgage lien. The mortgage acceleration clause allows the lender to call the entire loan balance due if the borrower is in default. The mortgage alienation clause is a provision in a mortgage enabling a lender to demand full repayment if the borrower transfers the loan. The mortgage escalation clause allows the lender to increase the interest rate of the loan under certain conditions. The mortgage due on sale clause requires that the loan balance is paid off when the title is transferred. The mortgage due on sale clause again requires the lender to pay the loan balance off when the title is transferred. The mortgage prepayment penalty clause requires the borrower to pay a fee if the loan is paid off early. Conforming loans typically do not provide for prepayment penalties. However, if the loan does contain a prepayment penalty, it must be disclosed in the note or on an attachment to the note and must be clearly disclosed on the loan estimate and closing disclosure. Under federal law, prepayment penalties are now restricted solely to fixed-rate qualified mortgages, may not be charged after the first 3 years of the loan term. The mortgage reconveyance deed, that's a method used to transfer title for a property following full repayment of a loan. The mortgage defeasance clause requires the lender to send a satisfaction of mortgage notice to the borrower within 60 days of paying off the loan. The mortgage exculpatory clause prevents the lender from requesting a deficiency judgment against the borrower when the proceeds of the foreclosure are insufficient to pay off the mortgage lien. The mortgage prepayment privilege clause allows the borrower to pay all or part of the loan before it is due without penalty. The mortgage open-end clause permits the future additional advances from the same loan. A blanket mortgage covers multi-tracts of land. A mortgage subordination clause permits a senior mortgage to assume a junior lien position. A partial release clause in a blanket mortgage allows the developer's lien to be released as the parcel is sold. A valid contract has 4 elements: competent parties, mutual agreements, legal object, and consideration. An attorney, in fact, is an individual with power of attorney who is able to sign the contract if one of the parties is not able or competent to sign. Utilizing a power of attorney, a POA must be approved by the lender in advance, and the lender may limit the person who can be a power of attorney to only an immediate family member, such as a spouse or parent or child. Please note that a POA may never be a party to the transaction, such as a real estate agent or the MLO. If no POA is assigned, then no one can sign on behalf of the borrower. The assignor is the party transferring the contractual rights to another. The assignee is the party receiving the contractual rights. The assignor can keep the servicing rights, selling a loan with servicing rights retained. The assignor can sell the servicing rights along with the mortgage and note to the assignee, selling a loan with servicing released. The grantor is the owner of a property. The grantee is the party receiving the title transfer. A deed is a written instrument used to convey title or transfer ownership. Deed restrictions may be placed in the deed and control the use of the property. Deed restrictions run with the land and cannot be discriminatory. A deed in lieu of foreclosure occurs when the mortgagor voluntarily conveys the deed to the lender in exchange for satisfaction of the debt. Debtors still lose property by conveying it voluntarily before final court action to avoid foreclosure on their credit record, and the lender is not obligated to accept the deed in lieu. Title insurance protects the homeowner, the mortgagor, and the lender, mortgagee, against defects that occurred in the past, such as undisclosed liens, heirs, fraudulent documents, etc. A title commitment binder is used after a search of public records. Either the seller or buyer or both will pay for the title policies. Issuing both the homeowner's and the lender's title policy at the same time is called simultaneous issue. A property survey is required and is certified to lenders, title insurers, and buyers. An easement is a right-of-way that gives someone other than the property owner the right to be on the land for a specific purpose. A deed restriction or restrictive covenant limits the future use of a property. There are 4 types of legal descriptions for properties: the monument method, the government land survey method, lots and blocks method, and the meets and bounds methods.